And I think at birth, to some extent, I was wired for capital allocation, but I think plenty of other people were too. I think the good news I can tell you is that to be a great investor, you don't have to have a terrific IQ. You know, if you've got 160 IQ, sell 30 points to somebody else because you won't need it in investing. What you do need is the right temperament. You need to be able to detach yourself from the views of others or the opinions of others. You need to be able to look at the facts about a business, about an industry, and evaluate a business unaffected by what other people think. And that is very difficult for most people. I mean, most people have sometimes a herd mentality, which can, under certain circumstances, develop into delusionary behavior. I mean, you saw that in the internet craze and so on. So I would say that I'm sure everybody in this room has the intelligence to do extremely well in investments. And the 160s won't beat the 130s at all, necessarily. They may, but I mean, they do not have a big edge. But the ones that have the edge are the ones who really have the temperament to sit, look at a business, look at an industry, and not care what the person next to them thinks about it. Not care what they read about it in the newspaper, not care what they hear about in television, not listen to people who say, you know, this is going to happen or that's going to happen. You have to come to your own conclusions, and you have to do it based on facts that are available. If you don't have enough facts to reach a conclusion, you forget it. You go on to the next one. And so you have to also have the willingness to walk away from things that other people think are very simple. And that's, a lot of people don't have that. I mean, I don't know why it is. And I've been asked a lot of times whether that was something that you're born with or something you learn, and I'm not sure I know the answer. But that temperament's important.
That's very good advice, that to be detached from all the noise that's come. Yeah. So you shouldn't just go with the herd.
If you don't know the answer yourself, don't expect somebody else to tell you. And if you don't know the answer yourself and somebody else says they know the answer, don't let that fact push you into coming to a conclusion about something that you just don't know enough to come to a conclusion on. When I started, I had way more ideas than money. I had $9,800 when I got out of school, and I was soon to get married and have children reasonably soon. So I had very little money, but I had lots of ideas. I just went through and looked at thousands of companies, and there were all kinds of things that stimulated me. Now we've got more money than ideas, so it shifts over to point. But the young investor, I was having as good a time 60 years ago as I'm having now, but I'm having as good a time now as I had then. The adventure is where the fun is, and I did not think to myself, if I have $1 million, I'm going to be way better off than I had when I had 10,000, or if I have 10 million, I'll be better off than 1 million. The truth is, I've lived well all my life. I've never had to worry about where a meal was coming or what bed I would sleep in, and I've been having fun every day doing what I do. And that was true when I was 21, and it's true today. Volatility is the friend of the. I love volatility. If no stock ever moved around very much, it'd be impossible to make any real money. Volatility is your friend. You can turn it into your enemy. I mean, if you get worried when your stocks go down, or you feel like you ought to rush in and buy things because they've gone up, volatility is your enemy. But if volatility means that a very good company someday will sell at X, and sometime later it'll sell at 2/3 of X, and another time it'll sell at 1.5 times X, you will get very rich if you can just keep figuring out what X is. And volatility is what will enable you to make a lot of money. So anytime people get upset about volatility, they don't really understand the nature of markets and how they should be thinking about them. If I drive by a McDonald's stand or a Kentucky Fried Chicken stand, I will automatically think to myself, what is this business worth? You know, and how many customers can walk in the door? What kind of gross margins can they have? How many people do they need? How likely it is that another chicken stand opens across the street? I mean, all of those things. And that's true of the chicken stand, and it's true of Google, or you name the business. I mean, it's all about evaluating the economic potential, the economic future of a given business. And most of them you don't know the answer on. But every now and then you run into one where you know the answer. But that's all business is. It's what Aesop said a long time ago. A bird in the hand is worth two in the bush. You know, that was said in 600 BC, and that's now what's called discounted cash flow and all that sort of thing. But Aesop had it figured out, 2,600 years ago. And all I'm trying to figure out is, if I take that dollar in my hand, when do I get the $2 out of the bush? How sure am I of getting it out of the bush? Is there some other bush where I can get $3 out of it instead? I mean, it's very basic stuff. And a lot of times you look at it and you say, I don't know how many birds there'll be in the bush.